Welcome to this explainer. Today, we're unpacking a fascinating executive briefing based on an anonymous expert report, and we're going to completely deconstruct the structural mechanics of business entities. We are strictly zeroing in on the mathematical and legal realities of how businesses are put together. Specifically, we'll be dissecting the profound, foundational differences between a sole proprietorship and an LLC, or limited liability company. The goal here is simple. We want to help you shift your mindset. We're moving away from reactive tax compliance, and instead, we're diving into proactive wealth architecture. And why does this matter? Well, because ignoring the structure of your business doesn't just cost you a few bucks, it fundamentally jeopardizes your long-term capital growth and leaves your personal livelihood completely exposed to uncompensated risk. Okay, let's dive straight into this. We're going to dismantle these default structures piece by piece. First up, the simplicity trap. Then, mechanics of self-employment tax, designing the corporate veil, the S Corp tax optimizer, and finally, strategic implementation. Section 1, the simplicity trap. Let's look at the actual cost of remaining in the default state. You know, when you first start generating income, there's this really common implicit assumption that operating as a sole proprietor is just the smartest initial choice. And I get it. It feels liberating. It's fast, it's free, and it's incredibly familiar. You don't have to file complex paperwork, you dodge state registration fees, and you just report your income on your personal tax return. Easy, right? But we absolutely have to ask the critical question here. Is that structural simplicity actually costing you? The objective analysis of this report reveals a fundamental truth about financial systems. The tax code doesn't reward simplicity, it rewards structure. What looks like a massive advantage early on, that total lack of corporate formalities, rapidly turns into a severe financial and legal liability the second your business actually starts earning serious money. So let's establish our baseline definitions so we really understand the core mechanisms at play here. A sole proprietorship is fundamentally just a business owned by one person, where there is absolutely zero legal distinction between the owner and the entity itself. Literally, you are the business. Because of that, there is a direct, undeniable cause and effect relationship. If the business goes bankrupt, you go bankrupt. If the business incurs a massive liability, it is your personal liability. Now, an LLC, on the other hand, is an entirely distinct legal framework created at the state level. It structurally separates the owner from the business operations, providing a very specific defined shield of limited liability. Let's look at this analytical side-by-side snapshot. Notice that by default, both entities get hit with the exact same 15.3% self-employment tax. Forming an LLC doesn't automatically just magically change how you're taxed, but the real differences start jumping out when you evaluate risk. The sole proprietorship carries an unmitigated, unlimited personal risk, plus a statistically higher audit risk. Why? Because sole proprietors frequently and sometimes accidentally blur the mathematical lines between personal and business expenses. Yes, the LLC definitely introduces more complexity, it requires proper filings and upkeep, but it dramatically reduces those critical risk vectors. Section 2, mechanics of self-employment tax. Let's thoroughly examine this 15.3% penalty. Moving from legal definitions over to mathematical penalties, here is the exact compounding cost you face by just staying in that default state. It's a 15.3% self-employment tax. Now, think about a standard W-2 employer-employee relationship. In that scenario, this tax burden is mathematically split right down the middle. The employee pays 7.65% and the employer matches it. But as a sole proprietor, you function as both the employer and the employee. So the system automatically forces you to absorb the entire 15.3%, and that is applied to roughly 92.35% of your net earnings. Breaking down the actual composition of that tax burden, you've got 12.4% going straight to Social Security and 2.9% funneled directly to Medicare. This creates what the analysis essentially calls a ruthless tax treadmill. This treadmill ensures that before you even begin to think about standard federal or state income tax brackets, 15.3% of your capital is just gone. It aggressively attacks your top-line profitability, which severely restricts your fundamental ability to reinvest capital back into your business for growth. And the kicker? The more you earn, the heavier this specific burden becomes.
Let's apply this math to a baseline $100,000 net profit just to see the real-world impact. Because this self-employment tax applies to roughly 92% of those earnings, this structural mechanism forces a massive $14,129 tax hit. Think about that. That's over $14,000 literally stripped from your working capital. And remember, that is strictly for self-employment tax. It exists entirely separate from your standard income tax brackets. It's a staggering depletion of your resources simply because you chose the default path.
Section 3, Designing the Corporate Veil. Let's talk about comprehensive asset protection.
So we've quantified the financial exposure. Now we need to look at the legal exposure. This quote really frames the issue perfectly. Operating as a single entity without a legal shield is an uncompensated mathematical risk to an individual's personal balance sheet. This isn't just about throwing fear tactics around. It's a highly calculable vulnerability. Under a sole proprietorship, you're essentially betting everything you own on the naive assumption that an accident or a severe dispute is just never going to happen to you. You aren't getting paid extra to take on that level of risk, yet your personal assets are sitting there, completely exposed.
The LLC solves this glaring vulnerability by establishing what is legally known as the corporate veil. Think of it as engineering a clean, absolute boundary between your personal wealth and your operational business risk. If the business gets sued, or if it incurs debts it simply can't cover, creditors are generally legally restricted to pursuing only the assets tied directly to that LLC. And just to be totally clear, a creditor in this context could be an unpaid vendor, a client filing a breach of contract lawsuit, or even someone who got injured on a job site. This structural veil is what keeps your personal balance sheet, your home, your car, your personal savings entirely insulated.
But here's the catch. Mere registration of an LLC is not enough to activate and hold on to this shield. You have to meticulously maintain the corporate veil through your day-to-day operational actions. There's a direct, unyielding cause and effect relationship here. If you commingle your funds, meaning you're casually paying for personal groceries out of your business checking account, a court can easily pierce that veil. They'll just look at it and decide there's no real legal distinction between you and the business entity anyway. To maintain the shield, you absolutely must utilize a dedicated EIN, strictly enforce separate business banking, and precisely document every single transaction under the corporate name. No exceptions.
Section 4, the S Corp Tax Optimizer. Here is how you structurally split your income. Okay, so we established that an LLC protects your personal assets. But we also noted that, by default, it doesn't actually lower that brutal 15.3% self-employment tax. However, the LLC provides you with the vital structural flexibility to formally elect S Corporation tax status with the IRS. When you pull that lever, you fundamentally change your legal and financial relationship to your business. You literally transition into being both an owner and a W-2 employee of your own entity. This structural shift is what allows you to split your income. One portion gets paid out to you as a reasonable salary, which remains fully subject to standard payroll and self-employment taxes. But, and this is the game changer, the remaining business profit is taken as a distribution, which completely bypasses that 15.3% self-employment tax.
Let's trace the exact dollar flow of this mechanism using our previous $100,000 net profit example. If you stay a sole proprietor, you are mathematically guaranteed to pay that full $14,129. But if you implement an optimized S Corp structure and pay yourself, let's say, a $30,000 reasonable salary, the 15.3% tax only applies to that specific $30,000. That drops your self-employment tax to roughly $4,590. The remaining $70,000 in profit elegantly flows right to you as a distribution, entirely exempt from self-employment taxes. Mathematically, just by changing your legal architecture, you've optimized your structure to save over $9,500 every single year.
Now, it's absolutely crucial to understand that you can't just exploit this mechanism by taking a $0 salary and 100% distributions. The system requires strict compliance.
The IRS mandates a reasonable salary based on very specific objective criteria. They're going to rigorously evaluate what someone with your exact level of experience, operating in your specific industry and located in your geographic region, would logically be paid to perform the duties you are performing. It requires concrete documentation and real market research. But when it's structured correctly within these established boundaries, it is a highly effective, totally compliant tax optimizer.
Section 5. Strategic Implementation Thresholds. Knowing exactly when to make the switch. The expert analysis identifies a critical threshold for your business, $50,000 in consistent net income. You know, there's a simplistic assumption among some entrepreneurs that advanced structures are just automatically better right out of the gate. Well, actually, scratch that. They aren't. Below this $50,000 level, the administrative burdens and the fixed costs of running an S Corp simply don't make mathematical sense. But once your profits consistently cross that $50K line, the structural tax savings finally begin to significantly outpace the maintenance fees. That's when you create a measurable, net positive return on your legal structure.
We have to be completely objective about the implicit costs here to fully understand why that specific $50,000 threshold exists. Advanced legal structures are definitely not free to maintain. You can expect roughly $3,000 to $4,000 in annual maintenance costs. This necessary overhead includes things like state franchise fees, significantly more complex corporate tax return preparation, and the monthly fees for the mandatory payroll software you need to ensure your reasonable salary is processed entirely legally. Escaping the simplicity trap is really only worth it when the math mathematically proves it's profitable to do so.
So how does this actually translate into a real step-by-step execution plan? The sequencing is highly logical, but it's distinctly non-obvious to a beginner. Step 1. Form the LLC at the state level to securely establish that legal boundary. Step 2. Immediately obtain a dedicated EIN from the IRS to separate your tax identity. Step 3. File Form 2553 within specific, rigid IRS deadlines to officially make that S Corp tax election. And finally, Step 4. Establish a formal, official payroll system so you remain fully legally compliant while successfully taking your optimized distributions. To summarize the core analytical findings of this entire briefing, true business wealth requires a fundamental shift in how you think. You have to move from reactive tax compliance, meaning you're just paying whatever the default system dictates, to a proactive structural strategy. The calculated transition from a highly vulnerable sole proprietorship into an optimized, insulated LLC is quite literally the ultimate de-risking and wealth-building mechanism available to the modern entrepreneur.
Which leaves us with this final, provocative question to analyze regarding your own operational framework. Are you simply paying taxes year after year by default, or are you ready to mathematically architect your business? Understanding these core mechanisms isn't just theory, it's the absolute first step toward true financial control and systemic wealth building. Thank you for joining me for this explainer. It's time to stop paying default taxes and start architecting your wealth.